Welcome to the Explainer. If you're an A-star candidate looking to completely master IGCSE Accounting 0452, specifically Module 28, on sales ledger control accounts, well, you are exactly in the right place. Think of me as your subject specialist, here to help you build a flawless conceptual understanding of the module. But throughout this Explainer, I'll also be throwing on my senior examiner hat to show you exactly where top marks are lost, and more importantly, how to secure them. We're teaming up the theory with the exam strategy to give you the ultimate edge. Let's get right into it.
Okay, so here's our agenda for today. We're covering 4 critical pillars. First, the core accounting architecture. Second, mastering step-by-step execution. Third, analytical tools for AO3. And finally, examiner insights and exam traps. We're basically going on an architect's journey today. We aren't just memorizing rules here. We're building a rock-solid structural framework for control accounts, and then we're going to inspect it to guarantee you capture every single evaluation mark. And yes, we're keeping the 2028 to 2030 syllabus updates strictly in mind.
All right, Section 1, the core accounting architecture. Let's lay the groundwork for the modern syllabus and go over some absolute, unbreakable, foundational rules for your sales ledger. Okay, putting on my senior examiner hat right out of the gate. While older textbooks or materials might use past terminology, the upcoming 2028 to 2030 syllabus updates are, honestly, utterly unforgiving. You must use the exact term irrecoverable debts, especially when you're writing off a customer's balance in the sales ledger control account. Please, do not use outdated terms like bad debts. Cambridge demands modern international standards now, and if you want full credit, 100% accuracy with this terminology is completely non-negotiable. Now, switching back to my subject specialist role, I really want to tie this directly into the prudence concept. The fundamental rule of accounting? Never overstate your profits by ignoring potential losses. We use this advanced technical methodology of cause and effect to understand this within control accounts. If you ignore a potential loss, say you fail to account for doubtful debts or you miss a vital contra entry, that is the cause. The effect, you end up overstating your trade receivables, which violates the prudence principle and artificially inflates your profit. A true A-star student is able to map out that exact chain reaction in their sleep. Let's elevate this, all right? We're moving from raw data entry to high-level financial intelligence. Control accounts aren't just tedious record-keeping. In fact, modern fintech platforms like Xero are entirely designed around handling these exact dualities in real time. And as an examiner, I completely agree with focusing on this. In the real world, control accounts are essentially the ultimate fraud prevention tool. They constantly check the overarching general ledger against individual customer accounts to ensure absolute integrity. This isn't just theory, it's real-world financial intelligence in action. Moving on to Section 2. Mastering step-by-step execution. Let's shift our focus to the procedural flow. This is your examiner-approved strategy to guarantee those crucial method marks, which will act as your ultimate safety net when you're sweating under extreme exam pressure. This step-by-step procedural logic is literally where candidates either sink or swim. Step 1, identify the source document. Step 2, record it in the books of prime entry. Step 3, execute the T-account double entry. Think of the sales day book and the cash book as this massive funnel. They take hundreds of individual daily transactions and funnel them all down into single, summarized periodic totals that flow right into your sales ledger control account. Moving sequentially like this secures your method marks because you're showing the examiner a highly visible, incredibly logical flow. Now, balancing the T-account correctly with a balance brought down versus a balance carried down is the absolute gold standard. But as your examiner, I need to warn you about a massive A-star trap right here: minority balances. Sometimes you're actually going to have a balance brought down on the credit side of a sales ledger control account. Why? Well, maybe a customer overpaid or they returned goods after already settling their account. Missing this minority balance is a structural failure in your accounting architecture. Don't let it happen to you. Speaking of pitfalls, while students often worry about entirely different topics, like missing symbols in a manufacturing account, in our world of control accounts, the truly deadly trap is miscalculating trade versus cash discounts. Candidates constantly mess this up. Listen carefully. In a control account, only the cash discount, the discount allowed, actually gets posted. Trade discounts never, ever touch the ledger. Falling into that trap will completely destroy your entire reconciliation process. All right, let's jump into Section 3, Analytical Tools for AO3. We are now moving into assessment objective 3. This is where rote memorization officially ends and your high-level evaluation and investigative skills truly begin. So imagine you're analyzing liquidity and you see a drastic drop in the current ratio, say from 2.5 to 1.1. That often points straight to the sales ledger. Anyone can calculate the ratio. That's just a baseline skill. Diagnosing the health of your credit control, now that is what defines an A-star response. You need to analyze your trade receivables turnover. Ask yourself, are your credit customers taking entirely too long to pay? A scenario like this demands immediate, investigative analysis. Exactly. You need to ask the right investigative AO3 questions. Why is cash flow freezing? Are your credit control procedures failing? Are major customers defaulting and turning into irrecoverable debts? You absolutely must debate these specific cause and effect chains regarding your debtors. Adopting this inquisitive, highly evaluative mindset is exactly how you diagnose a business's true health and secure those top marks. Now, you might be used to comparing things like straight-line depreciation against the reducing balance method when you're looking at fixed assets. But for inter-firm comparison in control accounts, the major difference usually lies in entirely different credit policies. One company might offer standard 30-day credit terms, while another offers 60-day terms with super aggressive early settlement discounts. You simply cannot directly compare their control account balances without accounting for these vastly different policy variations. And hey, never forget the non-financial factors hidden behind the ledger. What's the market reputation of your main credit customers? What is the quality of your customer relationships? Look, if your ledger is artificially inflated with high-risk clients who are likely to default, the actual quality of that asset is incredibly poor. Always look beyond the surface numbers to evaluate the true strength of the receivables. Section 4, Examiner Insights and Exam Traps. Let's enter our final section for a crucial masterclass on avoiding the exact pitfalls highlighted in the upcoming 2028 to 2030 syllabus updates and recent examiner reports. I'm laying down the law here with some crucial exam do's and don'ts. Do. Clearly show contra entries between the sales and purchases ledgers. We actively look for those method marks. Don't ever include cash sales in a sales ledger control account. Including cash sales is an instant red flag to examiners. It tells us you don't understand the fundamental purpose of a debtor's control account. Also, please do not rush with poor handwriting. If we can't read your minority balances, we literally cannot award you the marks. Let's talk about revenue versus capital items for a second. A massive structural failure point is mixing up the cycle of cashier. If you sell a capital asset, like say an old factory or a delivery vehicle, on credit, do not put that transaction in your regular sales ledger control account. That account is strictly for regular trade receivables derived from your revenue items. Mixing them up fundamentally distorts your core trading receivables, and it's a mistake we see all the time. Look, when exam pressure hits, your brain might just freeze on whether to debit or credit. While you know that assets equals liabilities plus equity, for this specific module, I want you to rely on this powerful memory hack for your control account debit side, Dr. SID. That stands for debit, sales on credit, interest charged to customers, and dishonored checks. Literally write Dr. SID at the top of your paper so your foundation never crumbles no matter how complex the multi-step problem gets. All right, we've made it to the end, and here is your pause and think A-star challenge. Let's say a customer's check bounces, but you mistakenly post the dishonored check to the credit side of the control account instead of the debit side. How does this double error specifically impact your total trade receivables and your trial balance? I want you to pause this explainer right now, grab a pen, and trace that multi-step error. Thinking through this exact type of complex chain reaction is exactly what separates an A from an A-star. Thank you so much for joining us, and keep building that perfect accounting architecture.